A lot of times people like, I think I know what that means, but I'm not sure what liquidity means. So liquidity just means cash. If you're familiar with your balance sheet, just to keep it simple, they have all the bank accounts listed at the top. They have things in order of liquidity. So that just means how cash and how quickly it turns to cash.
Welcome to Those Odd Numbers podcast. My name is Jason Snider. I'm the founder and CEO of Main Street Financial Group. We are your fractional finance team.
I'm Summer McFarlen. I'm a CPA and certified tax coach. I'm also the co-owner of Main Street Tax Group, where we do strategic tax planning so you can keep more of what you earn.
I am Masheka Turner, and I am the owner of Bright Skies Business Services. We are your outsourced accounting firm and profit first strategies. And we are here to help you create wealth through your business by gaining clarity around your numbers.
Welcome again, everybody, to another episode of Those Odd Numbers. Jason Snider here with Summer McFarlen and Masheka Turner again today. And we're going to talk about liquidity versus profitability, maybe more accounting finance terms, but a very pertinent subject that we run across quite often with profitability versus liquidity. How does it apply to my business? And I'll say it actually was part of the impetus of why our first company, Summit E-commerce, got started was the question of, hey, my tax return shows I made $80,000 last year, but I think I only have 5,000 or 6,000 in my bank account. What gives? What's going on here? And for our e-commerce inventory clients, it's usually all that inventory sitting on the shelves or in transit. Those are actually dollar bills or whatever currency that you end up using, sitting on a shelf somewhere or on a ship or on a truck. That's cash that's not available in your bank account, but it doesn't affect your profitability until you sell it. And for our inventory clients, that's usually where the answer lies. For us, Summer and Masheka, what's some other industries that you guys have experienced a similar conversation?
I just saw it recently with a prospect call they did recruiting and their compensation was 62% of their revenue. And it's a little seasonal too with the type of client they're working with. So I've seen that recently there. Doing taxes. Okay, here's your tax bill. And they're like, on what? What did I say? I'm like, you have a profit. And they're like, I don't have any cash. I'm like, we need to solve this problem. And so I see it a lot, or people are just clueless sort of, because they kind of go away by what's in the bank. Masheka, Yep. You got a war story?
Actually, I have seen it, particularly in the staffing industry. So what I see a lot is a lot of times they have to go ahead and pay the person and all the things before they bring someone on. So usually they've already paid the money out before they receive their money. So it seems like that the AR delay is always a cause for liquidity issues. Of course, I work a lot with med spas and weight loss clinics. One of the things, I've talked about it before, but one of the things I see that causes liquidity issues is sometimes they get talked into buying a lot of inventory. And this is the thing, you still have to pay for your receptionist. You still have to pay for your day-to-day items. And those day-to-day, the monthly rent, all of that stuff, it doesn't care that you have a bunch of inventory sitting on the shelf. It wants its money right now. So I saw that, but I think let's slow down a bit. We heard this word liquidity all the time. I think we should explain to people what liquidity actually means, because a lot of times people like, I think I know what that means, but I'm not sure what liquidity means. I'm going to take a stab at it. I'm going to try to keep it very easy. So liquidity just means cash. And so what that means is, if you're familiar with your balance sheet, just to keep it simple, they have all the bank accounts listed at the top. And so they have things in order of liquidity. So that just means how cash and how quickly it turns to cash. And so for the purpose of this conversation, there is the money you're earning, there are the things you're paying for, and then there is the cash that's in the bank. So for our purposes, that's what we mean when we say liquidity. Jason, I would love to hear maybe a simpler explanation if you have one.
No, you've done a pretty good job with that explanation. And then also you're correct, the ordering rules, I guess you might call it, for the balance sheet of starting from the top. And it also applies on the liability side as well. But many of you look at your financial statements on the balance sheet and you'll see current assets, long-term assets. The official definition, if you will, current assets is assets that can be or will be converted into cash within 12 months. And anything beyond that goes under the long-term assets. And same with liabilities. The same applies there as well. And so there are different parts of cash. Some things that may be labeled cash, like a certificate of deposit or other things like that, may be mislabeled on the balance sheet, where you technically don't have access to it, but it shows up as a cash account on maybe your bank statements and things. And so it may get misclassified on there. But yeah, liquidity is a very important thing, especially for a mix of the inventory and the labor, other expenses and things like that. And one of the things I try to operate by, even not even speaking to profit first, which we'll get to in a little bit, is trying to match up life assets and liabilities. And so if business is trying to grow, or they're growing and they need to acquire equipment or other things like that, is lining up the asset and the liability that funds that particular asset. The primary focus or isn't the best way to finance that, is to match that up, because a lot of mismatching cash, or a lot of cash issues come from mismatching assets and liabilities and when they're going to do it. So if you have, let's say, a company truck that's going to have a useful life of 3 to 5 years, even though the tax, correct me if I'm wrong on this number, I think it's 5 or 7 years currently on depreciation.
It's 5.
5 years. Let's say it's only going to last 2 to 3 years because of the use that you put on it. You need to plan for the 2 to 3 years rather than what it says on there. So matching those up is very important as well.
And I thought of one other thing too. And then just also, liquidity is just a longer version of liquid, which liquid just means cash.
Yeah.
So I was where did it come from? But liquid.
So if you maybe have seen some movies or other popular media where it says, "Are you liquid?" Or that's basically what that term means. It means it's all cash. It's there.
Yep.
The other part would be, like you were mentioning earlier, Masheka, is there are several expenses that you don't get to use in payables or something like that to extend out and maintain liquid. That's why payables, receivables management is very important. The timing of receiving those, especially for large amounts, of planning out your cash cycle, if you will. In larger businesses, more complex ones, there's the term we use, which we'll cover in an upcoming episode, I think, cash conversion cycle. Managing, understanding what those numbers are. And so if at a macro scale inside of a larger company is, when you spend $1, when are you going to get that dollar back? Based in, obviously, the shorter the day period, the better for the business, because then there's less cash needs that they need to finance in some cases, or plan for if it's funded internally and things. And so the other one is the 13-week cash forecast.
Yeah.
We've talked about that before in other episodes. It's a very powerful tool. It exists outside of any accounting platform that I've noticed. I haven't seen one that has built into it. So every single one we have to build, it resides outside of QuickBooks, Xero, etc. And so that's something that's a powerful tool, but it takes consistency and habits to maintain that, keep it accurate.
No, I agree. Because then, at least if you can forecast out, you can tell what's going out usually. Because unless it's something unusual, if your AR gets stretched, your accounts receivable gets stretched, that puts a good light on it.
And Masheka was saying earlier, your employees, you don't get to give them payables like, "Oh, sorry, I'll pay you in 4 weeks." They won't be around very much longer. Plus, you'll probably have the state people, labor board, looking at you pretty quickly if it reaches their ears as well. So we need to plan for those things, and those tools are available for us. Just any other industries that this is even more important. Obviously, some ones like us in tax, we have cycles that we have to plan for. We have labor costs throughout the year. We have big lumps, if you will, of the February, April time period, and then again, usually August, September, sometimes October, lumpy revenue. Then the rest of the year, it's pretty quiet. And so we have to plan for that. With some other industries that you guys have worked with?
I think I don't really work with them now per se, but as far as liquid, I think construction companies, it's a lot, because they always have to pay out their laborers, they have to pay out contractors. And of course, a lot of times the way it's set up, you can't just necessarily stop a job. You're already into it. I think, matter of fact, if I'm going to be bold, and somebody correct me on this if I'm wrong, but usually cash or liquid issues is what stops a lot of construction companies in their tracks. Because if you run out of money because of the scope of their projects, it's hard for them just to keep going just because of the nature of their business.
It's definitely a more challenging one, especially seem to have more surprises there in my experience, where the GC or the general contractor or the project owner runs across an issue, and because we work with a lot, I guess you'd call them subcontractors, so electricians, plumbers, other people, they're affected because until the project's finished, certain cash disbursements aren't going to happen.
You got retainage there.
Retainage there at the end as well, and that can last up to 12 months in some cases, depending on how large the project is and the terms of and then if it's a more risky type of, so like electrical work tends to fall into this as well, because it's pretty important. If there's a failure, it can cause a lot of problems. So those retainages can be longer and higher for those firms in some cases.
Yeah, I think that's why a lot of them have to file bankruptcy, right?
Yeah.
If the money dries up because they can't pay that construction interest anymore or anything. It's sad, but it happens.
It happens a lot. And one of the things that I've seen, sometimes I think it's even harder if you are a subcontractor of a larger contract, because what usually happens is you still have to pay your day-to-day, but you're waiting to receive your money from the subcontractor.
Yes.
And then, I hate to say it, but a lot of times they have a government contract and the sub is waiting on their money from the government. And it's just a trickle effect of everybody waiting on their money, but you still have to pay bills in the meantime.
Yep. And now we can add Profit First to the conversation, because that's all of our preferred solutions here. Get Profit First implemented, whether it's us doing it on your own. There's lots of content out there. See, specifically for some of the particular industries, I know there's a couple of books out there specifically for construction with Profit First, and you have plenty of support out there for that. And we have several contractors on our client roster that we're working with. Profit First has made a huge difference in managing those lumpy cycles of revenue and expense. Your expenses are always there. Your revenue is a bit lumpy. You need some plan, something, and unless you've got a very rich uncle who's willing to spot you a couple $1 million that you can leave on your balance sheet or in your bank account, which I haven't run across any of those, but I hear they must exist somewhere, because there's some, I hear about them, but they're not on our client roster.
Or in my family.
I was going to say, definitely not in the family. If they are,
They're hiding it well.
They don't show up to the family reunion picnic every year. But yeah, it's the best method out there for managing those cycles. And some of the specifics that we work with our clients is planning out the lumpy revenue cycles, getting the debt trimmed back as far as possible, getting rid of expenses. One of our clients, we did a review, just a light analysis, if we will, revenue versus per truck, just to show them what the debt service would need to be, what you need revenue wise to be able to support maintaining and buying another truck. And that put an impetus on, actually, we're not going to do that now. And things, and that kept some debt down. And this particular client, I think we're going to be able to reach a debt-free here in the next less than 12 months, I believe, from our current plan. And these types of things of habits, planning, awareness, intentionality, with Profit First answers all of those as well. And I'm trying to think of another industry we talked about, maybe Summer, Masheka, how it's impacted your clients that have the lumpy revenue, liquidity issues.
Me? In effect, our tax firm, Jason, has lumpy income, as you well know, because I was griping about it the other day.
Yep. But we have Profit First, and it is interesting. Sometimes people who you would think wouldn't be affected, high earning professionals, some accountants, it's not as common, but definitely in medical professions and other things I've seen, even where it's not as lumpy, but the liquidity issues there because of poor planning. But I think it comes down to making a big splash, purchasing an office building or a medical building to set up the practice in. And then other people who are maybe not as professional in their approach are hired to manage the finances. And then the firm is left in the lurch as they try to sort out the cash issues. Because also doctors can be affected depending on their insurance cash pay mix as well.
Your dentist they're not as busy in the summer. They are when
Yeah.
school's back in session, and especially a lot of the pediatric dentists, I don't know, there's a large percentage of their patients that are on Medicaid, right? And Medicaid only pays out so much. So they can get stretched too if they're not planning well.
And I think a lot of times too, and I just want to say to our audience, if you've been there, you don't need to feel shame about that.
Yeah.
We just need a plan, because this is the thing. A lot of people don't say, but probably 99% of businesses have experienced some cash crunch, even the big guys, because it comes down to cash. And let's just think,
They get bailed out by the government.
so you're exactly right about that. So we know that to be true. Because truth be told, the bigger you are, the bigger your bills are.
Yeah.
And the more employees you have on file, like Jason said, you can't push that down the road.
No.
Employees are cash today. So it's never something to feel bad or shame about. We just need a plan to deal with it, because that's the cycle of businesses.
Yep.
We're essentially, as business owners, we have to have our own liquidity available. And there's a wide variety of stats out there around business failure. The cash flow is the primary, which in my observation and experience, it's generally not a profitability issue. It's a cash management issue. And there doesn't need to be a lot of financial accounting training for the business owner to be effective at being able to manage that. There's plenty of resources out there, systems like Profit First as well, to help you bridge that potential knowledge gap and application to your business.
I agree.
Yep.
Any final thoughts before we end up today's episode?
No, I think we did good in explaining what it is, and even a few tips on how we can deal with it.
Yep.
We'll finish up today's episode here. We look forward to hearing from you in your comments and our various Spotify, YouTube. Send us some of your questions, and we might include it in a future episode as well. So thanks again, everybody. We'll see you on the next episode.
This content is for general informational purposes only and is based on current law and guidance as of the date of recording. Tax law and regulations are subject to change. This discussion should not be considered tax, legal, or investment advice. Listeners should consult their own tax or financial professional regarding their specific situation.